Hello, my name is Ben Nathan. Now, one of my longer term members had a fantastic question for me, and it's with regards to fundamental terminology and the effect that it has on the markets. So we're basically going to go through the three areas of interest that the members highlighted. So that's what it means to be dovish or hawkish, what the interest rate means and the effect on currency, and also sentiment versus fundamentals, when to trade one or the other. So we'll start off with point one, dovish and hawkish. As we know, we look at the market, and if the currency is strong, it's bullish. If the currency is weak, it's bearish. Now, dovish and hawkish is a similar thing, only it refers to the outlook on a currency. So as an example, if I think that the pound is weak and should fall over time, and I don't have a very good opinion on it, that means I'm very dovish, or I'd be a dove. Okay. Likewise, at the moment, I think although the dollar is weakened slightly, I think that ultimately it should be going back up. I think we'll be seeing a rate cut later on this year, and that some of the employment data, such as NFP, has made the US dollar fairly strong. So I'm a believer that the dollar is looking good. So I'm a hawk when it comes to the dollar. So dovish, hawkish, very similar to bullish and bearish, only rather than referring to what the market's doing at the present, it's the outlook, or a person's outlook on the currency as a whole. So moving on to interest rate and its effect on currency. Now this is an interesting one, because the key thing that drives fundamentals is the central banks of each country. And of course the main thing they do to drive that is raise and lower interest rates. So what does it mean? Well, let's have a look, or let's have a chat about what happens if an interest rate is reduced. So obviously, if a central bank reduces their interest rate, that's usually going to cause a commercial bank to reduce their own too. So in summary, lower interest rates make it cheaper to borrow. So it tends to encourage spending and investment. It leads to higher aggregate demand and therefore economic growth. So what happens is, if a country's economy is struggling, then the central banks step in, lower those interest rates. That therefore encourages public spend, and therefore that encourages more market spend. It encourages economy to grow. Due to the increased spend, that then of course opens up more employment, and of course a fall in the exchange rate makes UK exports more competitive and imports more expensive. So it's a way to simply grow the economy if the economy is struggling. So ultimately, if an interest rate's lowered, that'll have a negative effect on the currency, because the reasons behind having to lower interest rates are quite negative. But then what would happen then is, as long as the plan is a success, then in the long term the hopes are that the economy grows and that the longer term effect is good for the currency. So what about if interest rates are hiked? Well, again, going into the reasons behind a hike, normally there's got to be some good reasons for it. Okay, so but one is, if a bank is worried that inflation is going to increase to levels that could be deemed as too bad for the country, i.e. too high, then what they do to have the opposite effect of a rate cut, they increase interest rates. That therefore reduces demand and reduces the rate of economic growth. Okay, so in the hopes of stabilising a currency. So again, there's various economic effects of raised interest rates. So we have an increase in the cost of borrowing. So interest rates on credit cards, loans, they're more expensive, so it discourages people from borrowing and saving. And that also, people who already have loans, they're going to be less have less in terms of disposable income because they're going to be spending more in interest rate payments. On top of this, you'll have things like increase in mortgage interest payments and increase incentive to save rather than spend. So of course, less money is going from the central banks and more money gets stored, and therefore those higher interest rates increase the value of a currency. So it's something that affects both consumers and firms. Another thing as well, government debt interest payments increased, and sometimes there'll be some reduced confidence in a currency. So again, from the opposite of a cut, it leads to a fall in aggregate demand, which therefore slows down economic growth. Sometimes you'll have higher unemployment as a result, but there'll be an improvement on the central bank current account. So to put things very simply, a rate cut is normally the result of a negative economy for a country or a currency, and the plan of a rate cut is to improve, whereas a rate hike is quite the opposite. So the initial implications of a rate cut are negative, the initial implications of a rate hike are positive. Okay, so that's really what the interest rates are all about and its effect on a currency and the economy. So going on to sentiment versus fundamental, when to trade one and the other. Again, a fantastic question and a really valuable one for traders worldwide. So the fundamentals are really the baseline fundamentals. So it's what the central bank are doing. It's how they feel about currency. The sentiment is the shorter term picture. So as an example, now this is my opinion, but my opinion is that the fundamentals for the US dollar are quite bullish. Okay, because we know that we're expecting a rate hike this year. We've had month after month of really good NFP figures. So overall, there's quite a lot going on that's good for the dollar. So fundamentally, I think the dollar is fairly strong. However, at the moment, you'll notice, as of the time of this recording, which is 12 PM on the 24th of March, the US dollar is actually looking a little bit weaker. Now, the reason for this is because the FOMC were a little more dovish in their tones, in terms of, they said that while we will see a rate hike this year, they need to see some improvements to unemployment and some improvements to inflation. So they still feel there's room for the economy to grow. So therefore, while the bigger fundamental picture is ultimately we need a rate hike for the dollar, the current sentiment, which is a shorter term opinion, is that the dollar is a little bit weak following these FOMC comments. Okay, so another example. So again, we've got good fundamentals for the US dollar. However, we have some CPI readings coming out in half an hour. This will give a good inclination as to what the inflation looks like for this week. So if we have a relatively negative figure, then that's going to reduce the sentiment. So basically, if you're a day trader or a shorter term trader, you're going to really be trading on sentiment. But at the same time, you need to have a good outlook on the fundamentals. Whereas if you're a longer term trader, then you'd be looking at the fundamentals. So right now, as an example, I'm a day trader. So overall, the fundamental picture for me is the dollar's fairly strong, or it has been. However, I'm aware that there's a current shorter term sentiment which is a little bit bullish for the dollar. So if I was scalping or looking for a very quick day trade as of this moment, I would look to potentially sell the dollar. Whereas if I was looking for a longer term position, I'd be trading the fundamentals, and therefore I'll be buying into the dollar in advance of the expectation of a rate hike later on this year. So hopefully that clarifies the question as to the fundamental terminology and what it means for the markets. Again, for anybody that's not aware, you can ask me any question at any time. Okay? Even if you're not a member of one of my services, I'm still happy to give guidance where I see necessary. So if you have have a question, you can ask a trader by emailing bennathan@forexmentor.com. What we do is each week we'll choose a question and we'll cover that in a video tutorial. Have a good trading week, folks, and we'll see you next week.